Hello, everyone. Thanks for attending today. I'm Stephen Olson, the Faculty Director of the Graduate Tax Program here at Villanova. I'll be making a few introductory comments about the program before I hand this over to Professor Semes and the panel for the discussion. As everyone knows, Villanova is incredibly committed to providing quality education to our students, those accountants, CPAs, business professionals, and tax attorneys who want to further their career and increase their knowledge base. We're also very committed, though, to providing educational opportunities to our alumni, the broader Villanova community, and the broader tax community like this wonderful panel. Once you've reviewed the panel, if you're interested in learning more about the graduate tax program, please feel free to reach out to me or anyone else in our office. We would be more than happy to discuss that with any of you. We're closing applications for the spring semester right now. Summer semester is open. The fall semester will open in January if you're interested in applying. One last programmatic note before we move on to the panel. We're going to be doing another webinar later in the year, early next year, covering other tax topics. And for those of you who are SALT practitioners, if you're interested, in early June, we'll be doing a full day or half day SALT CE CLE seminar. We'll be hopefully inviting everyone here onto campus and also simulcasting it at the same time. So please keep an eye out for the invitation to that seminar. So without further ado, I'm really pleased to announce today's panelists. First, we have Candice Polsky, who is the Director of State and Local Tax for Urban Outfitters. Many of you probably heard of Urban Outfitters. They are currently bankrupting me because of the amount of money my wife and daughters are spending at Anthropologie and Urban Outfitters this holiday season. Prior to Candice working at Urban and bankrupting me, she was in the state and local department at a couple Big Four firms and a couple other national firms. Candice is also a supernova, having received her JD and her LLM from the Graduate Tax Program. We also have Drew VandenBrul, who is Managing Director at Grant Thornton, presenting today. He's on their SALT team. He's a local powerhouse in this area. Many people on this webinar probably know Drew. More importantly than any of that, though, he's an adjunct in our program where he teaches SALT classes. He's also created some of our more advanced, difficult SALT classes for the program. He's a student favorite here. Drew also has one of his degrees from Villanova. He received his MT from the grad tax program. Our final panelist is going to be Professor Mike Semes. Professor Semes is a full-time professor here at VLS, where he teaches our core tax classes and also a number of SALT classes. He's a prolific writer and speaker in SALT topics. He had a long career prior to joining us. So he served as chief tax counsel to a governor. He's got decades of experience in big law and Big Four in the SALT area. He's also currently of counsel at Baker Hostetler, where he practices in the SALT field. His accolades go on. And he also, we're sensing a theme here, has a degree from Villanova. He graduated with a JD from the law school. It's a great panel. Experts in the SALT field. We're really thrilled to have them for the presentation today. And before handing this over to Professor Semes, I just want to do two procedural notes here. In order to get your free CE or CLE today, you need to have two magic words at the end of the program. We're going to give you one of the magic words right now, and then at the end of the program, we'll announce the second magic word so you can get that free credit. So the first magic word is Villanova. We're not particularly creative with these. Again, that magic word is going to be Villanova. Second procedural note, if you have questions while we're going through the program, please put those questions into the chat feature. I will be monitoring that and I'll interject those if appropriate. And then hopefully we'll also have a little bit of time at the end of the presentation where we can answer additional questions if we haven't gotten to them. So thank you once again for attending. And with that, Mike, I hand it off to you.
Thanks very much, Stephen. And I'm really delighted that we have such a robust audience. And I'm also really delighted that Candice and Drew have joined us. I'm sure that you're going to find their comments very, very insightful. And also, I was thinking just for some reason this morning, you know, how privileged I am to work in this SALT area with such great people, people who we get along with, and what a great community we have in SALT and in the Villanova grad tax program. And I hope that we can use today's seminar to build that community even further. Well, we certainly have a lot to talk about. And for that reason, I'm going to just get right down to it. The core of our agenda is going to be on Act 53, which was passed in early July of this year. It was historic in that it enacted rate reductions in Pennsylvania for the first time in decades, and is over the next 8 or 9 years going to be cutting the corporate net income tax rate in half. But in addition, there are some more nuanced and technical changes that we're going to be discussing, and those include small business changes, credit expansion. There are a couple of sales and inheritance tax changes. We're also going to talk a little bit about the history, procedural history of Act 53, how it came to be. And one of the things that we'd like to stress there is the importance of being an advocate for your particular organization or your particular client, and staying on top of legislation and being an active communicator with people who are changing legislation and drafting legislation. And then we're also going to talk about some of the specific corporate changes that were contained in Act 53. Then we're going to move along to some significant judicial developments. And we're going to conclude by saying, okay, this is what has been enacted in this historic piece of legislation in Act 53 this year, but what can we be looking forward to in the near future? So I'm going to hand it over to Candice, and even though she is at Urban Outfitters, where thankfully my daughters are getting a little bit older and they're not bankrupting me this Christmas through Urban Outfitters, but through other stores, I'm going to hand it over to her, and she's going to talk to us about some of these small business changes and credit expansions. Candice, again, thank you very, very much for joining us.
Thank you, Mike. I'm very happy to be joining you. And I would have to say that even with my 40% discount and then sometimes 25% discount, it is also bankrupting me. So I could be on calls talking about tax and they talk about a product and I said, oh, that looks good. But anyway, starting with the small business changes, and although it's not something that I deal with anymore on a day-to-day basis, back when I was a practitioner, the first two changes were ones that were always traps for the unwary, sorry. And the first one is the 1031 like-kind exchange, where corporations did follow the federal treatment, but personal income tax, which would be the individuals, partnerships, S Corp, they did not. So you always had a track basis separately, and a lot of times that would get missed. And so now it conforms. There still would be some for prior changes, still having to track that. And also, there's always that little wrench in there about what happens if you have the property in one state and then you eventually exchange it in another state. How is that treated? Now, if you're a Pennsylvania resident, you're always subject to it, but there's always that disparate treatment if you're a non-resident. Drew, I don't know if you have any more with happening in the throw to you, if you had any more thoughts on the exchange of property in different states.
Well, I just had an overarching comment that we're seeing more of a trend under personal income tax in Pennsylvania to try to adopt internal revenue code sections. So we could have a whole seminar on talking about Pennsylvania personal income tax, but the main point is it doesn't adopt the internal revenue code. And I like to follow trends, and there's definitely been a trend. There's been a lot of legislators asking questions about why can't we simplify this? Why can't we follow the Internal Revenue Code? So these were very much active advocacy pieces, and they're good for small business. But I think there's both an opportunity and a trend to looking to align more of the personal income tax, which also includes partnerships and S corporations with the Internal Revenue Code. So I would look for possibly more of this in the future. And again, from an advocacy perspective, if you see something that would be beneficial to you, to your clients, I think the door is somewhat open to specifically adopting these sections.
Yeah, right. And then the other one being with the 179, because that was another one that was a huge trap, where Pennsylvania, for again personal income tax purposes, not for corporate tax purposes, had the different 179 expensing, where it was back to what the rule was, like early 90s, early 2000s, where it was, I think, what was it, 25,000, some ridiculously small amount. And now that also thankfully finally conforms with the federal treatment of 179 expense limits. Of course, there's still that tail of prior property that will need to be tracked, but fortunately that's going to be going away soon. So then as far as the expansion of credits, we can go on that. Just briefly, the things, especially the expansion of the limits for the education credits and the R&D credits. So many companies would apply in July. For first time, it's May if you're renewing, but July, and you find out you're completely shut out of the credits because so many companies would apply for it. So it increases that. The film tax credit increased a bit. An interesting story I saw in the paper recently about the expansion, and that expansion, that piece of it was supposed to go to small companies, and it turns out I think most, if not all of it, has gone to M. Night Shyamalan, because most film companies, they form separate LLCs for each project, so they technically fall within the limits. And then the other one I just want to make a brief mention of is the Keystone Opportunity Zone expansion and technical, the additional zones and the corrective language. That is one definitely where following the legislation and speaking up can help. We noticed a technical glitch in the expansion zones where it was not allowing for any wholly owned subs or restructuring to participate in the zone. So if you had to do some business restructuring that had nothing to do with tax, federal, let alone PA, and you needed to do a little reshuffling of the deck that didn't change any tax position, the law technically, according to DCD, shut you out from getting zone benefits. We let that be known, and that corrective legislation got in there.
Yeah, Candice, and I'll just, for those who don't deal with these issues on a day-to-day basis, DCED is the Department of Community and Economic Development who administers these types of programs, as opposed to the Department of Revenue, who just participates in the technical side of things. Great. Candice, thank you so much.
Yeah, just add a little bit more on sales, just some small sales, and then the inheritance tax, was a change as far as helping members of those who lost loved ones in the military, and the significance of the inheritance tax actually goes to some of the procedural changes, which now I will throw to you, Mike. So
thank you, Candice, and like Candice just said, the Act 53, which started out as House Bill 1342 back in May of 2021, was a one-page bill, maybe a 1.5-page bill that, like Candice said, just provided inheritance tax relief to the beneficiaries of a decedent who had served in the armed services. And it remained in that form through November of 2021, when it was reported out. It goes through the House, procedurally the first time, the second time, the third time. Then it goes to the Senate in December of 2021, Senate Finance Committee. It sits there for about 6 months. Then in June of 2022, the Senate Finance Committee reports it out for the first time, as it's required. At the end of June 28th, it reports it out again. So throughout May 21 through June of 2022, House Bill 1342 was a one-page bill that was limited to inheritance tax. There's a procedural rule in Pennsylvania government that says if anything that any bill, and I'm paraphrasing here, but any bill that relates to Act 72, which is where Pennsylvania taxes are codified, anything that once a bill starts as an Act 72 bill, anything in Act 72 can be added or amended and brought into that bill. So on July 7th in 2022, the Senate Appropriation Committee amended that House Bill 1342 by adding 48 pages of very, very significant corporate net income tax changes, which we're going to talk about in a few minutes. But my point here is to realize that from May of 2021, when House Bill 1342 was initially brought up till July 7th of 2022, there were a lot of discussions between the Pennsylvania Chamber was very active, the Allegheny County, Westmoreland County, Philadelphia, all of the various chambers were very active. Certain Pennsylvania manufacturers, Pennsylvania bankers were all very active in discussing these issues with the legislature and the governor. And if we're going to be looking back to history a little bit, we're going to know that for over 10 years, probably closer to 20 years, the Democratic governors have been proposing to reduce the corporate net income tax rate. I think everybody agreed that it needed to be reduced, but they said in order to reduce it, we need to broaden the base by having combined reporting. Well, what was unusual about this is that these 48 pages of amendments do not include combined reporting, and that was a very, very hotly debated issue. So I just want to point out here in presenting the procedural timeline that things can move very quickly, but it took them a long time to move very quickly. And on that July 7th date, things just all of a sudden coalesced and everybody reached agreement. And within hours, the Senate and the House added 48 pages of amendments. Now, query my jaded side will say, query whether any legislator read those 48 pages before they voted on them, but we'll put that to the side. And then on the next day, the governor signed it. So, Drew, why don't you talk to us about some of these changes in specific? Oh, I'm sorry if you had something else to add there.
Nope.
Okay, I thought I heard something. So yeah, why don't you talk to us about some of these specific changes, Drew, and some of the questions that we should be asking ourselves with respect to Act 53 being enacted.
Well, thanks, Mike. Yeah, with sensitive microphones, every time I come off a mute, it sounds like I want to interrupt, and I have a lot to say, but I'm going to try to contain it to these slides.
And we want to hear
So,
it.
yeah.
We want to hear it all.
I'm going to spend a few minutes on this slide, and then we're going to go through the details. And hopefully we haven't buried the lead here. We've kind of been leading up to this, that the corporate changes and the rate reductions are really the hallmark of this legislation, and it really is historic. But as we're going through it, I'd like to talk about some of these overarching issues so that you know how, not just the details of this, but how it applies, when it applies, what it doesn't apply to, more importantly. So that we can address it in the proper manner. So kind of going through the first question, who does this impact? Well, it impacts only C corporations, those subject to the corporate net income tax. So it's worth remembering that many of us have clients or work for businesses that are partnerships or S corporations or another form of entity not subject to the corporate net income tax. These may be relevant to you to know, but again, remember which situation in which you need to apply them. This is only corporate net income tax, and that includes the rate reductions that we're going to be talking about, the apportionment sourcing that we're going to be talking about, as well as the economic nexus. So keep that in mind. There's kind of guardrails around this, that it's corporate net income tax only and nothing on the pass-throughs or personal income tax. The when is an interesting question. So it's a two-parter. Mike just did a great job going through the when did this get enacted? And the lesson I took from that is never, ever make holiday plans for the 4th of July weekend, because no matter how much they try to plan ahead, it's usually somewhere very close to the 4th of July when these things really come to a head and the language changes and passes the legislature. But the important thing is it was signed into law in July. So for most businesses, that was the third calendar quarter. Candice, for you, I know that was Q2, so you probably had a shorter timeline in order to figure out the tax accounting piece that we're going to talk about in a minute. But it's important to know when to reflect the changes, especially if you're working with public companies that report on a quarterly basis. And the reason we're still talking about this in December is some of these things may not be news to people anymore. Hopefully not, since it was enacted in July. But for those that do annual tax provisions and annual audits, this may really be the time, as we're hitting the end of the year, when these changes get reflected in the financial statements. So it's still very timely. The other part, I said it was a two-parter on the when question, is when does this become effective? And we're probably going to reiterate this a few times as we go through the specific provisions, but these provisions are not retroactive. They're all effective for tax years beginning on or after January 1st, 2023. So in general, we'll talk about this on a calendar year basis. So this is a 2023 enact or 2023 effective dates for all of these changes, whether it be sourcing, rate reduction, economic nexus. So the retroactivity piece was important to keep out of this because that creates a lot of uncertainty and confusion. It's also interesting that we knew what the rules were going to be effective January 1st. We've known them since July 7th, July 8th. So may have been something that folks have taken into consideration around transactions that might close in 2022 or might close in 2023. So we'll always keep in mind and maybe come back and touch on some of the planning aspects. But this is prospective legislation. How does it impact the financial statements and tax accounting? Well, again, we could probably do a whole session on that. I might lose some of you that don't have to do this on a regular basis. But what's important is, as I mentioned, knowing when the event took place, whether it was calendar, Q3 or at least for the 12-month period ended in 2022, you need to reflect these changes. Because everything is prospective starting next year, it really shouldn't have an impact on your current tax rates, but it will have a pretty profound impact, I think, on deferred tax rates, things like your deferred tax liabilities and how they're valued at under the new rate structure, and things like deferred tax assets, primarily things like credits, but net operating losses are deferred tax assets, and they can be valued at the rates at which the benefits are going to be recognized. So there's always a double-edged sword to this. We'll get to the next slide in a moment with the much anticipated rate reductions, but just because the rate's going down doesn't mean that it's a good accounting answer for everybody. That's kind of the quirkiness of accounting, that if you have a lot of net operating losses and they had a value to the business at a 9.99% tax rate, as those rates start to climb down, the inherent value of those net operating losses goes down with it, and that's something that needs to be reflected in your financial statements when the law was enacted. As far as the uncertainty and guidance, I'm not going to talk to those off of this slide. We're going to give you some examples of some of the complexity, some of the specific language in here. You can judge for yourself whether this is certain or uncertain. I'll give you a hint. If you think it's certain, I would either read it again, or if you figured it out, we would love to hear from you, because as close as we may have been to some of this language, there's always going to be uncertainty and need for additional guidance. So with that, we get the other slides that move faster, because if I took that much time on every slide, we'd be here through dinner. So here's the bearing of the lead, right? This is the great news for Pennsylvania from an economic development standpoint. For most taxpayers, is this is the first significant rate change we've had since 1995. So it truly is historic. And you see the 1% reduction from the current 9.99 down to 8.99 beginning in January, and then it's just a half a point reduction annually through 2031, where the rate levels out at 4.99. So generally speaking, give or take a decimal place, it's a 50% rate reduction over a 9-year period. Extremely significant, and something, again, that needs to be taken into account for planning, for tax accounting, and simply in the compliance. So a couple things on this slide. Obviously
so,
there's a competitive.
Oh,
no, go ahead.
I
Sorry.
just want to just as far as with the rate and the good news, and as you mentioned before with NOLs, but even if you're not in a net operating loss situation, as I mentioned, and many of you may know, Urban is in a Keystone Opportunity Zone, which is a benefit. And some of our zones go to, because of expansion, to 2035. With this going down, and as you also mentioned, our quarter end was July 31st, and that the law change came in the beginning of the month, and we had to very quickly re-evaluate our benefit of the zone. And of course, then, even though it's nice from in one aspect of a current and deferred aspect, but we did have to, you do have to take an expense on the financial statements for that revalued benefit that went down because of the rate.
No, I appreciate the practical aspects of that, and also letting me catch my breath to realize that I did forget to say one thing that I think is important. And Mike, you don't need to go back on the slide, but I think the first sort of cynical reaction when we see the rate reductions is this really going to happen? Well, the answer is yes, it's in the statute. So again, tax accounting wise, you don't get to put the Vegas odds on this. I mean, the law says these will be reduced based on that schedule. They're not contingent on hitting any revenue triggers. So to the extent that you've seen these changes, and there's been a big trend towards rate reduction with surpluses in states this year, many of them have decided to condition the future rate reduction on hitting some sort of revenue collection number, which gets to be a mess from a tax accounting perspective because it's not certain. Right now, you read the law and it says it will go to 4.99%. That is the answer. We all know that the laws can change, and we're going to talk about whether this may be accelerated or some of the history we've seen around other taxes and delays in this. But it's important to keep that in mind. Just briefly on the neighboring states, this is always a competitive issue. There's a typo on here. I apologize for that. New Jersey is 11.5% with their surtax through 2023. So Pennsylvania is already pulled ahead of New Jersey with these.
No, the surtax is gone, Drew. The surtax, it's gone now.
I thought it was through 23.
No, I believe it's, I think, because I know for our 22, it's gone. If
Okay.
they up it, they didn't renew it, so it expired, yeah.
Great. So that's why it wasn't a typo, that was me at the last minute saying, wait, did that change? Okay, apologies. The point still being here that Pennsylvania was ahead of New Jersey, is now pulling ahead of all the neighboring states that have a corporate income tax, which I'm sure was part of this. And New Jersey, interestingly enough, somebody introduced legislation to further reduce their rate. So the states love to copy their neighbors and, query whether this is a trend and whether Pennsylvania, will start to, influence the neighboring states to pull down their rates as well. And Mike, if you go to the next slide, and this is sort of the national view that Pennsylvania falls, much lower on the list of corporate income tax rates. You see some of the states, mostly out west, that will have rates lower, but they're very few. So this is a huge competitive advantage, and one that I think Pennsylvania has been working on for a long time. All right, so uncertainty time, right? We know what the rates are. That part was certain. We know when it's effective. We know it was enacted. So we haven't hit you with too much uncertainty yet. But this is where we sort of get into the meat of the issues. As Mike said, there were earlier versions of this bill that talked about combined reporting. They talked about giving the Department of Revenue very broad discretionary powers. There are a lot of other changes, potential add back changes. It's helpful to know that it was much broader. It was kind of skinny down to this, and it believe it or not, this was kind of skinny down. You mentioned the page count, but it's important to know that the language that's in here, while it's never 100% certain, it is quite deliberate. And it's worth parsing through this, which is why we put some of the statutory language in to understand the workings of the receipt sourcing, how it applies to certain industries, and then there's some catch-all provisions, which unfortunately means you need to figure out if you fall into any of the specific provisions first, which so it may not apply to you, but you need to understand that first before falling into some of the catch-all provisions. The economic nexus piece, Candice is going to talk about a little bit more later, but it's a concept that Pennsylvania had in place through its corporate tax bulletin in 2019. It is now codified. We'll query whether the bulletin itself was codified or it's just the new language. But that's again a significant impact that will have some changes or affect taxpayers, and then no retroactivity. Mentioned that already. So the sourcing review, you kind of need a roadmap to get through to understand the sourcing in Pennsylvania. So here's your roadmap, just so that nobody gets lost right from the start. And the paragraph references here right out of the statute. The first is you source sales of tangible personal property based on paragraph 16. That's destination sales. We cover that in classes, but we're not covering that here because there's no changes. 16.1 was changed back in 2013 through that legislation to go to market-based sourcing for the sales of services, of which we have many questions. So I'll preface this by saying we've been waiting for answers to many of those questions on market-based sourcing of services, or what services means, since 2013, and we haven't really gotten those. So we may be on a similar timeline as we raise some of the questions here about the sourcing of intangibles. So the new paragraph 17 takes us away from the old cost of performance language that was in place to one that's generally market-based, and generally is the is the operative word here. That it's easy to say, oh, Pennsylvania's gone to market-based sourcing for intangibles. And not wholly true. It's a little bit of a mix, and again, that's where the uncertainty lies. So life was really easy back before 2013 when you had sales of TPP and everything else. And now the everything else is getting carved out into buckets and is going to necessitate, I think, a lot more guidance, a lot more definitions than we've been provided so far.
Yeah, and Drew, I'll just jump in and
Yeah.
just to clarify, or maybe just add just a touch of detail, that new 17 is what was enacted in Act 53, and that's what Drew is now going to go through in more detail.
Yep. Well, thank you. And feel free to jump in. I know both of you, we're going to talk about Synthes later, but we can't have a conversation about Pennsylvania tax right now without the Synthes case, which we're anxiously awaiting a Supreme Court decision on. But Mike, do you want to talk a little bit about, the first question about, is COP really market? I mean, that's been our question.
Yeah, and I think that you teed it up there very well, Drew, and this language, costs of performance, is the subject of a great debate, and we're, like Drew said, we're awaiting the Supreme Court's decision to tell us what is cost of performance. The Department of Revenue and Synthes takes the position that cost of performance really means market, and then that has a cascading impact on the things that we're talking about today, which are sales of specifically defined types of financial transactions and specific types of intangible property that is sold. And and then if we go back to the second bullet there, what is a service to be sourced under 16.1? The statute that was changed when 16.1 was added in 2014, it didn't define a service. And as you'll see when Drew goes through it in some more detail, the intangible property, which is sourced under this new subparagraph 17, intangible property isn't defined. And then there are, Drew, I don't want to steal your thunder here, but these are some of the ambiguities and uncertainties that we have been experiencing, and I'm sure we'll continue to experience. But okay, even if we define what a service is that is subject to the sourcing rules of 16.1, then we have to say, well, where is it delivered? And there's no guidance in the statute. The Department of Revenue has put out a draft regulation, circulated a draft for comment to the Bar Association, PICPA, and various other organizations, but that has not been promulgated or published yet. And then, as we see in so many instances with the delivery of software, can that service, assuming that the software is a service, can it be delivered to multiple locations? And if it can be, then, and we're looking at things like the NASCAR case in Ohio from a couple of weeks ago. Well, if it can be delivered to multiple services, how do we measure that? So Drew, I'll hand it back to you, and you can walk us through some of the details and other uncertainties.
Okay, yeah, Mike, why don't we just go to the next slide? Because some of these are duplicative. They have a larger font, and then we have the question. So the same thing here. So this is under 17. So we'll go through alphabetically a handful of letters here on these paragraphs. So under C, this is where we get into the sourcing of lease or licensing of intangible property. Again, I mean, Mike and I both touched on this. Where's the definition of what's intangible property? We sort of know what other than tangible property is, but we don't know where the line is between a service, between an intangible, and the more we see business evolve, the harder it is to figure out, whether this is truly a license of intangible property, or if there's components of service or other property in there. So that's really the first question, is whether or not it's intangible property, and then trying to associate the use or the extent to which it's used in Pennsylvania is the next area of uncertainty. So I mean, this is why we're waiting for the regulatory guidance. Mike alluded to this, but I always hammer this point maybe a little too hard. I mean, 2014 was administrative guidance on the market-based sourcing of services. We've seen no regulations issued. We've seen drafts 2 years ago that have still not come out of the Department of Revenue. So the optimist in me says that they're going to go back and build in the intangible property sourcing into the regulations so that they can cover services and intangibles, and maybe we'll catch up. The pessimist says, well, it's going to take another decade after we get the services regulations to figure out what is intangible property and how we source this. So you can see where the uncertainty is. And I mean, we're picking on sort of the nuanced areas. I mean, there may be some things that are pretty straightforward as a license of intangible property. You can't conceive of it being anything but that. So you certainly fall into these provisions, but you're always going to have the question of, to the extent to which it's used in the state, unless you can see some of the language in D, unless it's specific to a geographic area that you're licensing a right, an intangible right to be used within the Commonwealth of Pennsylvania. I think it's going to be an open question.
Right, and then Drew, to compound the uncertainty, okay, if it is used in Pennsylvania, how do you in your example of the licensing of an intangible, how do you measure it? Do you measure it by dollars of royalties? Do you measure it by percentage of use? Do you measure it by the seat license? Lots of room to roam there. But what about some of the financial transaction sourcing, Drew? Maybe you could talk to us about that a little bit.
Yeah, so this is where you need to read through the sections to figure out if they apply to you, and if not, it's sort of a decision tree. If they don't apply to you, then read on to the next section until you sort of get to the end. So the first one in E talks about sales of securities held primarily for sale. So there's a point of departure. If you're in the financial services business, I mean, if you're holding securities and you're trading and primarily selling them, E may apply to you. But in most cases, at least based on what I see, there's a lot of acquisition, redemption, holding of securities. But if they're not primarily for sale, if you're not in that trader business, then that's likely not going to apply to you, and you don't need to look at the sourcing of those to Pennsylvania. If that is your business, it's going to be based on the customer location. But again, this is pretty narrowly construed. If we move on to F, this is where we get into the lending, and this is interesting because there's been a lot going on with financing, both related parties and unrelated parties, unaffiliated. And that's really the key thing to focus on. What's highlighted here in F is that we're talking about a corporation that regularly lends funds to unaffiliated entities or to individuals. Well, once you pick that out, that makes you think about banks, financial institutions, those that are more akin to being subject to the bank shares tax. And you'll see, if you're familiar with that area, some parallels in the language here. But there's a huge difference between somebody who regularly lends to unaffiliated entities akin to a bank, and what we see a lot of times in a corporate structure, which is centralized treasury functions, affiliated lenders. You get one entity that borrows in the commercial paper market or borrows from a bank and funds the operations of its affiliates. So it's important to distinguish that once you get into an affiliated situation, you fall out of the provisions of paragraph F, and you kind of get into the same thing with G and H when gets into loans, et cetera. And I is pretty much the credit card version of these. So these are all very specific. We'll change the sourcing for unaffiliated lenders and credit card banks, and the language is in here that helps with the sourcing. But we sort of walk through that to get to the underlying part in J. Thanks, Mike, for advancing the slide, which is, why do we have to read all that other stuff? We had to read it to make sure that that doesn't apply to the situation that you're looking at. And if you say, well, I've got interest not otherwise described above, well, we didn't describe anything about affiliated indebtedness and lending above. So presumably, you fall out of all those sections and you land in paragraph J. And if that's the case, then it's included in the numerator, the sales factor, only if the lender's commercial domicile is in the state. And we probably could underline lender, because that could have gone either way. The states look at this in different manners. So it's not the borrower, it's the lender in these situations that looks to its domicile. And if that's in Pennsylvania, then I think this reads in a way that says that the lender picks up that interest in its sales factor numerator. But otherwise, if the lender's domiciled outside of the state, you don't end up with a Pennsylvania receipt on any of the affiliated interest. And then I'm just going to cover K, and then we can jump into it real quick. I mean, we filtered all the way through this. Now we get to the everything else, the catch-all kind of clause. So anything that's from intangible property, remember, none of us have offered up a final definition of what that means. But if you think it's intangible property and it isn't described above, then it's excluded from both the numerator and the denominator of the sales factor. So Mike, I don't know if you're going to unearth your accountant's example that we've talked about before with the numbers, but I can do it. It's funny, the CPA using the words and the attorney trying to give the numerical example. But yeah, I would think of this as something like goodwill. We see a lot of transactions that result in a sale transaction that results in goodwill. That's intangible property. Right now, that gets included in the sales factor and may get sourced to Pennsylvania. Under these provisions, effective beginning next year, they get excluded. So a sale of goodwill, I would say, gets excluded from the numerator and denominator of the sales factor. Again, double-edged sword. Good answer. If it was going to be sourced to Pennsylvania, you're glad to see it go out of both the numerator and denominator. If it was only going into the denominator, giving you a lower factor, you're probably not so happy to see that go. And we are only in December. I suspect there's transactions that are teed up that may close at the end of the month, may close on January 1st, and literally you could have a one day difference in execution of a transaction or triggering of a gain that may end up with a completely different sourcing result.
No, that's great, Drew. And I just wish we had more time to go through these kinds of things. There's a tremendous amount of meat on those bones. And thanks for walking us through that. So I'll segue back to Candice here by saying that the economic nexus provisions I view frankly as bootstrap nexus, because they're tied in. You usually say, well, first question, we've gone through in all of our SALT courses. First question is, do I have nexus? Then the second question is, okay, what's my base? And then how is that base apportioned? But I don't get to how my base is apportioned until I have nexus. But here, those sourcing rules, apportionment rules, determine whether we have nexus. So with that, Candice.
Right. So, and I'll, in the interest of time, go through this part quickly to get to the good, juicy stuff of the cases. But so, with Wayfair on the sales tax side, that introduced the dollar threshold or transaction threshold in the sales tax. I would argue that on the income tax side, economic nexus would go back to the Lanco case, which I believe was 2000s. Where, really from an income tax side, that economic nexus was there, but Wayfair brought in the dollar threshold, which a lot of states have tacked on to. The important things that I want to bring up with economic nexus is, number one, despite the Multi-State Tax Commission trying to destroy it, PL 86-272 would still, in theory, exist even under the thresholds. If you still have if you're selling tangible personal property into the state, you're not in the state at all you're doing is selling, then it doesn't matter. You might be subject to sales tax nexus, but you, I would argue, are still not subject to income tax nexus, just merely under $1 threshold. There is the carve out for foreign affiliated entities in a tax treaty country. I would say, just to skip along again, in the interest of time now, there is the argue over whether it's codification or of the bulletin. They did try to sneak in the bulletin, and most people say, well, wait, that has to be a statutory change. Even though there is economic nexus under LANCO, $1 threshold is slightly different. You got to put that in the statute. So we have the both language in there for you to go back and peruse on your free time, or if you want to, if you need to get to sleep, either way. But also just some, things to think about is that if we go to the issues, because like I said, I want to skip forward and get to the cases, but the effective date is 1/1/2023 on or after the financial statements that could bring you to have some additional filings. So to think about from your deferreds. Also from an add back standpoint, if you have additional filings now, you can relook at where you need to add back and maybe not need to do that in as many jurisdictions, because now you'll be subject to tax in Pennsylvania when you otherwise would not have thought so. And there are states that have started to put this theory into place on the income tax side. So like I said, the biggest things I want to stress there is don't forget about PL 86-272 on that one. So
That's right. That's PL 86-272 still is good law. Congress has not repealed it.
And like I said, I know, in this day and age with multi-tax, the multi-state tax, commission trying to put in cookie nexus and internet and all that, but I still say that that's not, until states adopt that's not the case anyway. So that's the biggest takeaway I would take from this right now.
Absolutely, Candice. And before we get to the next segment on some interesting cases that have come down recently, I think it's also important to note on that effective date that if economic nexus gives you a better answer beginning 1/1/23, but you have been filing based on the corporate tax bulletin, I think that you have a strong argument to go in for refunds. And similarly, if you weren't filing, you should maybe say, okay, now maybe I'm gonna have to start filing 1/1/23. But I think there could be some refund opportunities if people were following that corporate tax bulletin and say, look, this Act 53 isn't effective until 1/1/23. And it demonstrates that there is a clear intent of the legislature to adopt a new rule, and therefore that bulletin was frankly not necessarily valid. Okay, Candice, you want to walk on through some of the cases that are hot?
Sure. So as Drew had alluded to, the Synthase case, this was such an interesting case, and also little near and dear to my heart, as I'm pretty sure based on the timing, I prepared the returns that were amended, but I still maintain it was good. It was on good authority. There is some, and it also just shows there's so much that can go on behind the scenes that you don't realize is that, so these were returns that based on cost of performance. Synthase was based in Pennsylvania, and all the items were sourced to Pennsylvania. Well, Pennsylvania was going back to that, is cost of performance really market? There were some audits going on, especially I think with like financial institutions, mortgage companies, where on audit, the Department of Revenue was pulling that, well, cost of performance is really market. So when Synthase was saying, well, wait a second, if cost of performance is really market, we shouldn't be sourcing all of this to Pennsylvania. So they amended the returns and filed for refund. Well, when it got to Commonwealth Court, I believe it was the council, because for the state was saying, well, no, it's cost of performance, it's sourced to Pennsylvania. And the Department of Revenue stuck in and said, well, no, it's market. They should get the refund. And you're thinking, well, why would the department be in favor of the taxpayer? And my surmise is that because in most cases it would work against they want it to be considered market because of all the other cases going on. So if a case came out that it said it was sourced to Pennsylvania, then they lose on all these other cases that are under audit. So it's interesting because the council, and you have two state departments arguing against each other. And at least as of right now in Commonwealth Court, they said that you defer to the Department of Revenue. And if the Department of Revenue says it's market-based, then it's market-based and they should get the refund. Now, keep that in mind for when I get two cases down there, because it had been argued that the decision has not come out at the Supreme Court, but PA Supreme Court. The next case I love because this is a taxpayer-friendly decision, Online Merchants Guild, and I believe it is completely the right answer. And in this is cases where sellers have used Amazon fulfillment services, fulfillment by Amazon, and they basically turn the package over to Amazon, and Amazon can store that inventory wherever it wants. The seller itself has no idea where it goes for the most part. There are small exceptions, but we're not talking about those exceptions in this case. And the Department of Revenue tried to assess these sellers, saying, well, you had inventory in the state, therefore you're subject to sales tax. And the Commonwealth Court said, no, they had no control over it, and therefore, you don't meet due process in that case, because they didn't realize they were purposely availing themselves of the services of Pennsylvania. And interestingly, the Department of Revenue has chosen not to appeal that case, because I don't think they want a decision on that, on a Supreme Court decision on that. So right now that, in under those facts, it is that the state cannot subject these sellers to sales tax. Other states are not so friendly. I know California insists that the sellers are subject to tax, and it's unfortunate because it's gonna, it actually has the potential, to put these small businesses out of business. So good decision on the Commonwealth Court on that one. Then Greenwood Gaming, this one is more about what it means, because like I said, cue back to Synthes in this case, which had to deal with casinos and whether selling tickets was a service or property, and whether it was part of the base for gambling taxes. But the important part is that the Supreme Court decided that you do not defer to the Department of Revenue, that they do not need to get deference simply because they're the department. So, that might be a foreshadowing of what happens with Synthes. We'll see. Well, place your bets. No pun intended.
And Candice, on that, I think you're spot on in everything that you're saying, and I'd just like to underscore that Justice Wecht, in his concurrence in Greenwood Gaming, underscoring what you're saying, said that the Department of Revenue is totally off base to assert that its interpretation is to be upheld unless clearly erroneous. I mean, those are some pretty strong words. And so it'll be interesting, because Synthes is a statutory interpretation case, and will he continue to hold that point of view in Synthes?
Right, and for a plug for Mike, a great article written on Greenwood Gaming, and so check that out. Great analysis on that. So yeah, and then the quality driven co-pack that deals with the manufacturing exemption and for sales tax, and what what comprises of a complete change, so under the law, there must be a transformation. In this case, the taxpayer basically took a bunch of food, put it together and made it like a to-go package, like a full complete meal. And they were arguing that that was enough transformation. The court said, no, it isn't. And I from my view, at least just from the reading of the case, I agree with the court on that one. I don't know, Mike, if you have any.
No, well, I'd never say that I agree with the court when they decide against the taxpayer, but I would just add that on exceptions, which came out last week, the Commonwealth Court again was very clear in its language, saying, hey, and exceptions, for those who don't practice in Commonwealth Court all the time, exceptions are required to be filed if you want to go to the Supreme Court, and you have appeal as of right in tax cases to the Supreme Court, state tax cases. But anyway, so it's basically a re-argument, because the Commonwealth Court serves as a quasi-trial court. The Commonwealth Court in these exceptions, I think, had some very, very stern language saying, look, you didn't raise any additional arguments, so why did you bother filing exceptions? Because the parties can stipulate that exceptions have been denied and then go on their merry way to the Supreme Court. And it was, I think they admonished the counsel somewhat severely. But anyway, Zilka,
fun one. So this one goes back to the Wynn case, which was a U.S. Supreme Court case with Maryland. And for those of you would be familiar, that in Maryland, when you file the personal income tax return, it includes a county local component. So you have the state rate, and then you have a local rate based on where you're a resident. The state collects that money on the return and then distributes it back to the localities. And in that case, the state, the counties at the time were not allowing a credit of other state taxes against the local portion of that tax. And what the U.S. Supreme Court said was that no, it should be allowed, that if you have the credit against, if you paid in another state, the credit should be taken against the full amount of the tax. Now in Zilka, you have in Pennsylvania, right, we have the state tax, and then all of the localities, especially Philadelphia, the city wage tax, which is specific in this case, is a separate tax. It's not on the Pennsylvania return. The Pennsylvania State Department of Revenue does not collect the money or distribute it. In this case, the taxpayer wanted to claim a credit because in Delaware, the Delaware tax state tax rate is higher than the Pennsylvania rate. And the taxpayer wanted to claim the overage of that credit against the Philadelphia wage tax. And that was denied. And it's also been denied at the Commonwealth Court level. The court said this is different from Wynn because it's not state collected. It's a different jurisdiction. It's, it just so happens there's no violation. It just works out that because the taxpayer works in Delaware and lives in Philadelphia, that's just what happens sometimes. They're not bound to make a taxpayer completely whole all the time. So that's been appealed. I know there are cases where if they say that it looks at Wynn, it shouldn't matter whether it's a separate, that would be form over substance, and that there is an enabling act on the state level that allowed the Philadelphia city wage tax, and therefore it should be treated no different than Wynn. And others say, well, no, the big difference with Wynn was because it was state administered. And again, that there isn't the need to make a taxpayer fully whole on all time in all circumstances. So with that, Mike, I'll let you make some comments before we go into the NOL cases.
I'll just point out that the SCOPA, Supreme Court of Pennsylvania, is likely, my bad, to hear arguments in the spring of 2023. The taxpayers filed their reply brief either this week or last week. Thanks, Candice.
And although it has no bearing on what the outcome is, that was not an as of right appeal to the Supreme Court. So they did decide to take it because it was a local case. tipping my hand a little bit. I'm certainly glad they took it, because I'm not sure that we wanted the Commonwealth Court decision to stand. But it's interesting in its own right, and it's interesting in this remote work environment, hybrid work environment, whatever we're in now, that these cross-border, I mean, people traveled and worked in different jurisdictions before, but there's a lot more life to this, and I think there's a lot of perspective impact to that. So it's a really interesting case, regardless of which way it goes. But I was glad that the Supreme Court took that, because as you said, Mike, I mean, most of the state tax cases are as of right appealed to the PA Supreme Court. This one was not.
Yep, great distinction. Thank you.
So NOL cases, again, I'll start with why you should care about this. And maybe you don't, but I care about this. Here's the funny story. I care about this because Stephen mentioned all of our Villanova credentials when we started. I got my master's at Villanova in 1998, and I had a writing course, and I, as a young pup, decided that, they just started these NOL limitations in Pennsylvania. They suspended them, I think, in 1995, reinstated them with 2 different types of limits. In varying years, the limits were different, whether it was a fixed dollar limitation and or a percentage limitation. I looked at that, and then I buried myself in the basement of the library at the law school and found all of the books on uniformity cases and said, geez, I don't think this limitations meets the uniformity clause. I don't know why it was so hard. That was 1998. We're still trying to figure this out. Stephen agreed to up my grade to something more commensurate with a case that has been, an issue that's been litigated now for over 20 years. But thank you, Stephen. It's even higher than last time. I'll take it. So why should you care about this? There's always the procedural issues on this, but also, I have clients that have refund claims. I have clients that, we represent, the ones that we audit. We're on, various sides of this, where many of these old years are still open under statute because of refund claims, and Pennsylvania continues to impose, now it's limited to a 40%. It's at a 40% NOL limitation. So the limitation continues. It's been narrowed down to just a percentage limitation based on the court's decision in the Nextel case. But they keep litigating these, and it's quite interesting, because there is a possibility that that there's either relief granted to the specific taxpayers involved, and we're sort of working backwards in the years. So the Nextel cases actually dealt with more recent years than some of the GM cases. So, there's potential taxpayer specific relief, and there's obviously the hope for those who have, cases pending these decisions, that they'll be, that the court will eventually throw out the, somehow throw out the NOL limitation, either, on uniformity grounds, on due process grounds. So Mike has a really good chart. If you go to the next slide, I mean, this is a good takeaway to have. It's a bit of an eye chart. I can see it with my glasses on, but I refer to this an awful lot. So I appreciate you sharing it here in the slide deck. I mean, this really, if this is an issue near and dear to you, this walks you through all of the relevant information, right down to who wrote the opinions, and which cap was involved. So you can see the first half is the Commonwealth Court history. And then repeated in Nextel and GM2, which is your most recent decision, with the NOL cap. So it's sort of the gift that keeps on giving. We keep fighting, keep litigating this issue, and then we keep trying to debate whether the decisions at this point should be construed to just the taxpayers and their specific facts, or if they're more broadly applicable. And there is much debate on that. But I think if we're talking about decisions coming up, I guess we're still waiting for the Alcatel-Lucent case. So I'm not sure that I can point to one where it's the caboose on the train, but the Alcatel-Lucent case was argued in June of this year. So there's still some litigation going on here, and we will eventually get to resolution. I like this because there's the history aspect of it, but we're going to talk about some trends and things to watch going forward, and the continuing uniqueness of Pennsylvania's 40% NOL limitation is something that is likely to get scrutiny, not only from the courts, but maybe at some point, through some legislative changes. And Mike or Candice, I don't know if you have anything more.
Drew, I just add that Alcatel-Lucent was argued en banc, meaning probably on exceptions, but before the entire panel of the Commonwealth Court in June. We don't have that decision yet, but they typically issue decisions 3 to 4 months, but they might be waiting, for, I don't know what they could be waiting for, but they're taking some time to issue their decision. It's been almost 6 months now. Okay, cases to watch. We've just included a few cases here that are working their way. They've not been decided by the Commonwealth Court yet. We don't know whether they may be settled. And by the way, the preponderance of cases that go from the Board of Finance and Revenue to the Commonwealth Court are settled. But one of them is Trader Joe's. And in that case, it's interesting because the Commonwealth appealed the Board of Finance and Revenue decision, not the taxpayer. So the taxpayer won at the Board of Finance and Revenue, and they won because what happened is, as Candice mentioned, the add back provision, and it says basically intercompany expenses, intangible expenses are to be added back if they're paid to an affiliate. And what happened here, and then the statute goes on to say that if that there's an exception, it doesn't have to be added back if the principal purpose of that expense was not to avoid state taxation. So what happened here is Trader Joe's adopted certain intercompany restructuring, payment of royalties to an affiliate, before Trader Joe's did business in Pennsylvania. And so they are arguing that their principal purpose was not to avoid, as the statute specifically says, tax imposed under Article 4 of Title 72. And Article 4 is the corporate net income tax. So Trader Joe's enacted this, implemented this restructuring before they were subject to Pennsylvania corporate net income tax. So how could the principal purpose have been that they were trying to avoid Pennsylvania corporate net income tax? The Commonwealth Court the Commonwealth in Commonwealth Court is arguing that it doesn't matter that they weren't subject to Pennsylvania corporate income tax. They were still trying to avoid, their principal purpose was still to avoid state tax generally. So we'll see how that plays out. Teva Sales and Marketing is a scenario that's becoming, I think, more and more familiar and something therefore to watch. And that is when somebody sells either tangible personal property or services to another entity, is that other entity the source to which those sales are sourced, the location to which those sales are sourced, or do you look through to that customer's customer? And so that will be another interesting case to watch. And,
Yeah.
and we put, yes, Candice.
Mike, I would say for personal reasons, even though I don't deal with it as much anymore, but as a practitioner, I dealt with it so often. So I really hope it doesn't get settled and there is some ruling on that, because that's such a big thing now, especially like website hosting or like even I saw we're administrators of benefit plans and the web, there's so I think it's more the norm now, and there just is not much guidance on that. So I'm hoping for that one that becomes an official ruling, but we'll see.
Yeah, no, it's interesting because you have the Gilmore case, which is tangible personal property, and says, look, if the customer picks it up in Pennsylvania and then takes it across the bridge to New Jersey, that's a New Jersey sale. And I have trouble understanding why it's different if the customer picks it up or some other party picks it up. But, and then you have all kinds of questions of proof. How do I prove, how do I know who my customers are?
I think that's the biggest thing, because with tangible property, usually you can have that proof, but with web hosting and those kind of things, it's so hard to find out who the customer's customer is, but there are some where I've seen some, rulings that have ruled that you look through the customer's customer
Right.
on the service side. So
Yeah.
that's,
Well,
Well,
Mike, you and I have talked about this, but I've seen 2 audits and 2 sets of assessments with lots of zeros after them for taxpayers in the same industry. I think fairly similarly situated, where the department has argued customer sourcing and customer's customer. And so if the facts are the same, you can't get to both answers. I think there's just that amount of uncertainty that nobody wants to give up their bargaining chip on either side of this, and until everybody kind of disarms on this issue. So it's interesting that intellectually you just can't get there. Obviously, we can advocate for a client, the department can advocate for his position. I'm just not sure how anybody can really take both positions. But that will have to come to a head here pretty soon.
all right, and just let me ask you a really stupid question, Drew. When the department is taking those 2 mutually exclusive positions, does the result in both of them give them more tax?
Yes.
Wow. Wonder how that happens.
Oh, I almost missed the sarcasm at the beginning. I thought, like,
That's
we're going to have a talk here. Yes, they're assessing because there's more tax.
Okay,
So,
so yeah,
but,
so
I mean,
lawyers wonderland, accountants wonderland, and I think there's going to be, full employment for all of us for quite a while. But Drew, why don't you talk to us a little bit about some of the things we could be looking forward to on the horizon?
we've reached the crystal ball section of the presentation. So, well, I think we've kind of laid out the groundwork for a bunch of these. So, why might
Drew,
Pennsylvania want to increase the
Drew,
NOL cap?
can I jump in real quick?
Oh, sure.
Just in case we go a few minutes over and people have to drop off. I'm just going to give everyone the special magic second word now, and then I'll let you guys continue with your presentation. So the second magic word everyone will need to get the free CE and CLE is tax. So
I
first,
guessed it.
yeah,
I guess
I get $2.
the crystal ball works. All right. So thank you, everyone. Drew, I apologize for interrupting.
That's okay. Hopefully the participant count doesn't drop here. But no, seriously, the NOL cap has been an issue. We talked about that. There's been a push to increase it or to abolish the cap and allow full utilization of the NOL. It's been a fiscal issue. I mean, the Commonwealth has gotten used to the tax dollars on limited NOLs. Now, if you just think about it, the corporate income tax rate is going to be cut in half over the next 9 years. The value of those NOLs to both parties is going to be cut in half over that time frame. So is this the time where it becomes an affordable change? So that's one thing to keep an eye on. The other is accelerating the net income tax rate reduction. So, let's not be greedy about this. I mean, this is a very beneficial historic change, but given some prior history with how the capital stock tax, franchise tax phase out went and was delayed multiple times, there's a degree of skepticism that the legislature is not going to override those changes. It certainly would go a long way, especially if we continue with a budget surplus, to push to accelerate those. I think a lot more of the skeptics would come over to the non-skeptical side and say, wait, not only are we sticking to it, but we're going to accelerate it. And obviously there's political and fiscal implications to all of that, but it's being talked about. It's something to watch. And then one thing we haven't talked about,
Actually,
and I'll have
real
to
quick, Drew, I'm sorry to interrupt you, but real quick on that. Governor-elect Shapiro has come out publicly, at least I was in an event over the weekend, where he said that he would like to accelerate the CNIT rate reduction. So something clearly to watch. Thanks.
I say maybe I'd combine.
We've got to watch for the other side. Well, I mean, it will be the governor's first term. It's always an adventurous first budget, and sometimes what gets proposed the first time takes 4 times, 8 times. We've seen this before. So, it'll be different thinking. Just 1 minute on the SALT cap workaround. This is the $10,000 federal SALT cap that came in back in 2018 under the Tax Cuts and Jobs Act. All I'll say is 29 states have come up with a workaround, basically an elective entity level tax with a credit to the pass-through entity owners that is designed to allow a federal deduction above the $10,000 cap. It was pushed for very aggressively in Pennsylvania. Like I said, 29 other states have it. Pennsylvania did not do it. The stated reason was the Department of Revenue just embarked or just completed a huge system migration and just went live, and they thought that would disrupt that. So that has happened. Let's see if the SALT cap workaround, the pass-through entity tax, gets reintroduced, and if there are other objections, or if it goes through, just to keep Pennsylvania in line with the other states. And I'm going to stop there and Mike, let you do the wrap up or add some other thoughts on the table here.
Thank you very much, Candice and Drew. I think your insights were very, very valuable. I hope our audience found them very valuable. And I'll just thank everybody again for participating, being a part of the Villanova graduate tax community. And I'll pass it on to Stephen and wish everybody a happy holidays, and pass it on to Stephen to take us out.
Thanks, Mike. I have no further comments. I appreciate Drew and Candice participating with us. Again, that final magic word to get your CLE and CE is tax. And please be on the lookout for future webinars that we'll be providing next semester. And for that full or half-day SALT seminar we'll be doing in early June. Should be really exciting. Thank you all again for your attendance, and have a wonderful afternoon. Bye.